All right, folks, so we are in a fascinating moment in time. We have been on a downtrending slope since recent cycle highs at the end of July, and we are about 3 to 4% away from entering correction territory. The S&P 500 has lost some $3 trillion in value since the last Fed rate hike in July. Markets have gone from a buy the dip attitude, which we saw most of this year, to a sell the rally attitude. And it's been pretty damn bloody. We have bond yields continuing to climb as markets anticipate higher for longer rates. On the other hand, you have crude oil futures climbing aggressively and consistently since the end of June. If you look at the 3-year, the reprieve in pricing is over and we are on the pathway to $100 a barrel once again. You look at how that relates to gas pricing here in LA. In many neighborhoods, it's pretty common to see gas well over $7 a gallon. The whole state of California is averaging around $6. You look at the overall country, the average is $3.83, but that's expected to move up aggressively as well. Just for comparison purposes, I know they say comparison is the thief of joy, but average gas prices in January 2020 were $2.50, and that was before the pandemic. Now, if you are a Pastafarian and break out the Bollinger Bands, you are seeing an aggressive consolidation towards the lower band, marked by a failed reversal to the upper band in the last period, which historically has tended to mean you're going to see more consolidation and more lengthy downward pressure. In order to reverse the trend, you now would need to move aggressively upward over the course of 4 or 5 trading days, and then, even then, it would be a weak setup. Probabilities are looking tilted towards more downward pressure heading into the early weeks of October. And again, markets have gone from the buying the dip mentality, which we saw most of this year, to the selling the rally mentality. Chase's Jamie Dimon came out with another gloomy prediction and is urging Chase's clients to be prepared for rates as high as 7%. I would be cautious, he said. I think we are feeling pretty good because of all of the monetary and fiscal stimulus, but it may be a little more of a sugar high. He added that deficits can't continue forever, and as policymakers continue to face this alongside an array of other serious issues, including the war in Ukraine and volatility in oil and gas markets, interest rates may need to go up even more than anticipated. He sees rates potentially as high as 7%. Markets have thus far been able to fight off much of the fear of record high interest rate increases, but it's unclear if they'll continue to do that as rates stay higher for longer. You look at the probability of a recession in 2024 as predicted by the yield curve, it just keeps going up and up and up and up, and there's 2 big ways that people are looking at this. One group, one camp is saying, well, wait, it's been going up so aggressively for this whole year, yet no massive economic collapse has occurred, at least not that the government is admitting. So who cares if this just keeps going up? Obviously, it's been wrong so far. And then there's the other group, the other camp, that knows that this increasing line doesn't guarantee that you're in a massive collapse, but it means that the probability of one is going up at a rapid clip, and it's more and more likely as the line goes up because that's how probabilities work. Just because the economy hasn't taken enough to trigger emissions from the government doesn't disprove the long-term history and the long-term success of the yield curve in predicting recessions and recessionistas. Speaking of government, another issue is the likely coming government shutdown. If the shutdown happens, it will be the 4th in a decade and will be just 4 months after a similar standoff between Republicans and Democrats, which led the federal government to being within just days of defaulting on its $31 trillion debt. It seems like every month now there's a new governmental crisis, and that's simply because spending is out of control, but any efforts to stop overspending get compromised away again and again and again. In fact, the U.S. spends around 44% of its GDP per year on government, about the same levels we spent back in World War II, which of course is a big stinking problem. A government shutdown means a lot of federal museums will close, national parks will close or have reduced services, you'll have more flight delays, FDA food safety inspection disruptions, infrastructure projects will be put on hold, transportation repairs put on hold, food assistance and early childhood education programs will also be lost. But from a market perspective, the reason it is an issue is because it calls into question the stability of the United States. I know this has happened before, but every time the U.S. shows political instability, its financial risk goes up. Credit rating agency Fitch already downgraded U.S. credit in August following the debt ceiling crisis. Credit rating firm Moody's said Monday that a shutdown would be credit negative for the U.S. in their view, potentially endangering the country's last remaining AAA rating from the big 3 credit rating agency firms. U.S. credit ratings have been steadily going down decade after decade, and once they go down, they never reverse. And worse credit, of course, means worse rates on loans and more financial instability in markets. At the same time, around 2 million civilian federal workers and another 2 million military workers would face delays in getting their paychecks. And nearly 60% of federal employees are stationed at the Department of Defense, Veterans Affairs, and Homeland Security. Not areas you want to stop payments to, folks, and something that is extremely embarrassing for the world's richest country. Now, it's likely that this shutdown will result in a compromise that includes more excessive spending and couple more months until you get another threat of a government shutdown. The government is already borrowing $14 billion per day and spending $3 billion per day on interest expenses alone, and that is expected to continue to climb. Now, when the government borrows money, that money is not free. I know the government tells you it's free. I know that a lot of politicians tell you it's free. I know a lot of people in the media swear that it's free, but that money is not free. You and I will end up paying for it with a destroyed currency, higher future taxes, and worse institutional instability. Speaking about faulty government, there's also a fake out in data occurring pretty consistently, which is freaking out markets quite a bit because it's creating a huge area of uncertainty that markets used to not have to deal with. We keep having these government reports come out and they say one thing and then boom, it gets revised to be much, much worse and markets get confused. You look at personal consumption, for example, which, by the way, is the value of goods and services purchased by and or on behalf of U.S. residents. You could see the pre-revision original reports in green and then the post-revision in turquoise. And you could see that in all cases except one, there is a big discrepancy and over-reporting in the pre-revision versus the post-revision. They'll originally say, oh, we're all the way up here, markets will rally, and then boom, a few months later, they'll revise the data to be in deep in the negative. You've seen different variations of that almost every quarter for the last couple of years. And Q2 reporting is another pretty aggressive over-reporting as well. So markets right now are freaking out. You got untrustworthy government data. I mean, it's always been pretty untrustworthy, but now it's a lot more untrustworthy. You got a potential government shutdown, which is looking more and more guaranteed. You got big dogs like Jamie Dimon warning that not just the rates are going to go higher for longer, but they're going to go up to 7% perhaps. You've got a lot of different indications in terms of recession indicators like the yield curve, and I could go on and on and on. But that is the moment in time that we are in right now in the stock market, and that is the data that you should be looking at if you're trying to gauge whether you should be going long or short, or whether you're trying to play off the overall market's trends with something like a triple Q or an SQQQ. SQQQ, of course, shorts the tech sector, and triple Q, of course, longs it. TQQQ leverages the longs on the tech sector. So different instruments that you could use to play off the overall volatility. But right now, it's a very, very interesting moment in time, and I'd be curious to know your thoughts on today's market. Do you think that we're heading up after this massive sell-off, or do you think that we're going down? You think the trend's going to continue to be pointed to the downside? Let us know down below. We love hearing from you. And we'd love to have you sign up to get our completely free email reports. I'll put that as the first link down below. Have a good one, folks, and I'll see you in the next video.